Redfin just reported a dip in home prices, and I want to just go right into this. It's not a big dip, but is it an indicator as to whether or not we're going to see a wider dip in some areas? U.S. home prices ticked down 0.1% in April, the first monthly drop since 2022. I'm looking at this and saying, well, what's going to happen next? That's the question I want you to ask, because this is the first decline in over 18 months. And year over year, growth slowed to 4.1%. That's the lowest since July 2023. And if you're looking at this and wondering, okay, well, what areas are doing well? Which ones are not? First, I want you to see that this is the Redfin Home Price Index. You can see here, if I zoom in, or you can go and take a look at it, I'll put the link there so you can take a look. But if I'm zooming in, there's a slight, tiny drop at the top. Now, this is the year over year national price point, S&P Core Logic. And you're going to ask, well, Tristan, what the heck is the difference? How do I use each? How do I look at them? And it's fairly simple. I want you to look at this as they're very similar, but they're looking at different things slightly. And you have Redfin's, which is telling you quickly what's happening. What's happening with the house prices. It treats sales pretty much the same and looks at more cities than Case-Shiller. And you're like, well, Tristan, why the hell is Case-Shiller even important then? Well, it not only takes a little bit longer to report, I think more people are used to going to Case-Shiller because they've been doing this for so long. They've been gathering the data. They look at more expensive home sales, and they focus on smaller sets in big cities. I think it just comes down to people are used to it, and it's been there for longer. So they're saying, well, why would we trust Redfin over Case-Shiller? I think they're going to come out and say, hey, you know what? Our report says something similar. Looks like prices are down whenever they report. So prices are down a little bit. You just see now the highlighted areas that I'm talking about here so that you understand why demand is down, or at least what they're saying is the main reason. And I think this is because overall, you're looking at the nation and saying affordability is just, that's the biggest challenge we've got. Who can afford all the homes out there? There's only a small amount of people that can. And this is why you're starting to see in some areas the build of inventory over and over. And it's probably going to get a little bit worse in some areas than it is now. Demand is falling. Pending sales down 3.5% month over month. That's pretty big. You just saw that report come out a few days ago. Now, buyers are hesitant due to the economic uncertainty with high rates and what's happening with the economy. You're watching people second guess what it is that they're actually going to do. And if you look at this, say, hey, isn't it spring? Aren't we supposed to be like going really great? Homes selling, everyone putting their home on the market, and people actually buying them. What the heck is going on? It comes down to that high interest rate. A lot of people just can't afford when a price of a property has gone up so much and the rates are still really high. Because there are a lot of things to this article. I want to show you the areas, and you can see here, they're all alphabetical. I think there are 50 here that they chose. 50. It says prices fell in 25 of the 50 most populous metro areas on a seasonally adjusted basis in April, month over month. And you have here, the biggest decline was in Charlotte, North Carolina, 1%, negative 1%, followed by Virginia Beach, negative 1%, and then Miami, 0.7%, right? Not even a percentage point. Now, you've got prices increased most in Nassau County, New York, 1.8% month over month. Warren, Michigan, 1.3%, and New York, 1.2%. What you're finding are a few different things, and I want to, let me go back to, I want to go over these 5 things with you. I wrote them down here. It says, these are the 5 things that most people aren't watching, and these are the things that I want you to pay attention to, because you'll have the media cover other things, but not typically these five. And here's what could make this 0.1%. I wrote down what could make this 0.1% dip a leading indicator or bigger trouble in certain markets, right? Florida, Texas. I think those are the main ones that people are concerned about. And then parts of New Orleans and the surrounding areas, just the South in general. California is doing okay. We've got New York, Northeast doing great, New Jersey, and Connecticut doing pretty good. But here's the key. Here are the five. Investor pullback. In boom markets like Charlotte or Miami, heavy investor presence means fast liquidation when prices stall. That means if investors decide to pull out, they're going to then sell things at a discounted price because they want to get out fast. That could cause a problem. So watch for that. Number two, insurance trouble. In places like Florida or California, deals fall apart because insurance premiums are skyrocketing or policies are unavailable. So not only are we seeing clients back out once they open up contract, once they're under contract, open up escrow, once they're in there, they realize, whoa, insurance is way higher than we thought in some areas, or we can't even get insurance. So they have to back out. This is why we're looking at people, if they're going to purchase, to understand what that looks like first, the insurance. But watch for that. Insurance troubles. Number three, builder inventory. And I thought I saw an earlier graphic that showed that Florida and Texas have the highest new construction right now. And that could be an issue because builders are quietly discounting new homes, especially in suburbs, undercutting resale values. And that becomes an issue because if they see that there's a dip, they could make that dip grow even more because they don't want to lose money, so they want to get out ahead of it. And they're going to discount, and that could cause prices to drop in those areas more than what we're seeing now. Number four, shadow inventory. I'm not worried too much about this, but there's always talk about shadow inventory. I put here mortgage delinquencies aren't always visible, but when those homes hit the market, they drive prices down quickly. Why? Again, because banks typically in a slightly down market, if we get there, in a slightly down market, we're going to start seeing companies, banks, investors, they just want to get rid of things before they have to lose more money. And that, again, creates a problem on the bank side. That's if we start seeing this. But remember, there's a lot of equity out there. So even people that are behind and maybe have a notice of default, if they sell, most of them are going to be okay. There's no reason to sell under market value. But shadow inventory, too early to tell on that one. Number five, migration reversal. Areas that gained during the pandemic, Austin, Boise, a whole bunch of Florida, are seeing people move out or pause plans to move in. Those are the things I outlined because I want you to pay attention to those things. In fact, when we showed, a few days ago, I showed a map. I wonder if I can find it right here as I'm talking to you. I was looking at this map from Resi Club that showed that there are it's a tale of three cities. And you watched the people that moved out of areas like New York and California into areas like Texas and Florida, Boise, Idaho, and other parts of the South. You're watching now those people are like, well, we want to move back, or we need to sell, or what the heck is going on? We can't do anything with our home because prices are now either stagnant, too much inventory. Prices are now going below what they bought them in some cases. And so you're seeing a reversal of that a little bit, and you're not seeing New York and California suffer as much. In fact, I don't know that New York is suffering at all when I looked at their inventory. California at different parts, but remember, even in California, you've got San Jose, the San Jose area is still the hottest place in the United States for properties going up. And you're like, that's no way. I'm like, yeah, because a lot of the deals happen cash, right? Same thing with New York. About 50% of all deals are happening cash. You're like, where are they getting this? Well, you've got the older generation who has properties, has homes, and they're funding all these other deals that are happening as well. Now, so pay attention to all the little details that you may not see with the media because they're distracting us. They're giving us what we want to hear, that the real estate world is crashing. It's going to be in different parts if it gets there, and different cities are going to react differently. Remember in 2008, 2008-ish, not every place crashed. There were only a few states. Some didn't even move. Nothing happened in some states. Expect the same thing to happen if it happens here. Just pay attention as it's developing. I'll be talking about the leading indicators in a couple of videos from now. So just watch out for that. Have an awesome day.